Okay, now let us discuss about cash dividends. Okay, cash dividend are normally stated as so many cent per share. So it can be interim and final dividend. So company shareholders may change if the shares are traded on the stock market. So let me give you an example. You have A has maybe 10,000 unit of shares. This is 10,000 unit of shares. Okay. And then the company declare 5 cent per share. This is the interim. Yeah. And then the final dividend is another 10 cent. 10 cent. This is per share. This is your final dividend. Normally the announcement was made by this per share, yeah, the dollar or cent per share. So if you have 10,000 unit, so you need to multiply 10,000 unit with 5 cent. So that you have $500 here. Is it $500? Yes. That is your cash dividend. And then another one will be $1,000. So your total dividend that you're going to receive from this company is 1,500. So this is the cash payment for you. You're going to receive the money, but for the business, they're going to issue cash. They will issue cash to the shareholders. So the journal entry will be debit dividend paid, and credit cash. Credit cash. Yeah. Okay. To ensure that dividends are paid to the right owner of the shareholders, dividends are often declared on one date. So we have one specific date, for example, maybe on 31st December. We declare dividend on 31st December. Okay, example, this is any date will do, yeah, and are payable on some future date to the shareholders. Dividend is not an expense. Dividend is not an expense. Dividend is appropriation of profit to the shareholders, and a payable on some future date to the shareholders. Maybe the date declared on 31st December, but the payment was made on 31st January next year. Okay, there's a question whether dividend is expense. No, no. Dividend is expense. No. Okay, no. Dividend is appropriation of profit. Appropriation of profit. Or you distribute the profit. Okay. Example, let's put example. The revenue is 20 million. The expenses is 14 million. So the profit is 6 million. Can you agree with me? Revenue, expenses, profit 6 million. And yeah, and after that, you need to pay tax. You need to pay tax to the government. For example, the government tax you 25%. So you need to pay tax to the government. This is your responsibility. You have to follow the income tax or corporation tax rules. Example, 25%. So you need to pay government 1.5 million. This is how government make money, yeah, by taxing businesses. So the balance here available will be 4.5 million. So this is profit for the year. We call it profit for the year. Profit for the year. 4.5 million. And then you have to decide whether you're going to give this money to the shareholders or you're going to keep the money. You're going to keep the money. Whether the business is going to give dividend to the shareholders or the business will use the money for their expansion, for their future project. So there's a question. Let me check. Or can you just invest the money so you don't have to pay tax to the government? Okay. If you don't pay tax to the government, you'll go to jail. You'll go to jail, yeah? Every year, the government want to know your income statement. They want to see your audited financial statement. You have to fill in certain document. If the government, okay, identify or know that you make a profit of 6 million, whether you are happy or not happy, you have to pay them. You have to send 1.5 million to the government office, to the tax office. Yeah. Even though you want to give all the money to the shareholders, the answer is no. You have to pay the tax first, and the balance can go to the shareholders. Or if you want to invest all the money in all the profit, you want to reinvest to a new project. No, it will not be like that. You have to pay the 1.5 million tax to the government. For the Muslim, you make a profit of 6 million, you want to sadaqah, you want to give to the poor, to the needy people, to the orphanage house, the 6 million, no, you cannot do that. You have to pay tax first, and then the balance, the balance you can distribute to the shareholders, or you want to invest into new project. Maybe there are some country they allow you to give certain amount of donation can be included as expense or not. It depends on certain on the countries, the tax rule of the country. So from this 4.5 million, the question is whether you're going to keep or invest, or another one you're going to give as cash dividend. Cash dividend. So when they announce dividend on 31st December, they will announce when they're going to make the payment, maybe 31st January next year. So we have here the announcement date of dividend or the declaration date. Another one is the payment date. For preference dividend, the dividend must be paid on the preference shares before any paid on ordinary shares. The directors may decide not to declare a dividend on either preference share or ordinary shares because the company has insufficient amount of net asset. For example, net asset minus liability is negative. So if you have 45 millions and you have preference shares, maybe 6% preference shares, 6% preference shares, okay, of 20 million, this is the number of shares. So from this 45 million, you must pay the preference shares, the preference dividend first. Preference dividend, how much you're going to pay? 6% multiplied by 20 million. This is dollar, yeah? So that costs you 12 millions. And then the balance will be 33 millions. Okay? Pay the preference dividend first before paying the ordinary dividend. That's the rule. Pay the preference dividend first before you pay ordinary dividend. Okay. Next is participating preference shares. It have the right to receive further dividend above fixed rate once ordinary shares have received dividend up to the stated percentage. This is additional privilege given to the participating preference share. They have their fixed rate, and then the payment made to the ordinary shares, and then they entitled for more extra payment. But it doesn't popular in many countries. Normally, we only have very fixed percentage of preference dividend, and the balance will go to ordinary shareholders if they plan to distribute dividend. Next is share dividends, a pro rata distribution of additional share to the shareholders, normally consisting of distribution of additional ordinary shares to ordinary shareholders. The share dividend should be distinguished from cash dividend. This is more on another way of doing it by pro rata distribution of additional shareholders. But it's not so popular. I mean, after giving dividend, after you give dividend to your preference share, to ordinary shares, and then you have extra payment, extra cash, extra profit, you can distribute based on pro rata basis, based on that if you want. Yeah. Next is share split. Share split is a process whereby you reduce the market price of the share, but you're going to increase the number of ordinary shares. So it makes shares available to wider range of investor. So a share split basically does not change the balance of any of the equity accounts. Example, This company, Z, their ordinary share capital, they have this 1 million share. Maybe not 1 million is small, yeah. 100 million share, ordinary shares. But the price of this share is $50 per share, maybe 1 million. Just put 1 million, much easier, yeah. 1 million ordinary share, the price of one share is $50. Is $50. So the value of the total share will be 50 million. 50 millions. Okay. So it's quite difficult to sell a share at price of 50 million. Not many people have that enough money to buy shares at price of $50 per share. So the company can split the share, reduce the number. For example, from 50 million, they break into 5 shares. So now it becomes $10 per share. Because they break the shares, split the share to 5 units, so the number of share here will increase to 50 million ordinary shares. So the number of unit increase, but the share price reduce. The total is the same, 50 million. No change in your balance sheet, but there's a detailed calculation for that. Yeah. Instead of 1 million multiplied by $50 per share, now you have 50 million. Sorry, 5 million, not 50 million. 5 million multiplied by $10 per share. Or if you want to split more, you can have $1 here. $1 per share. The number of share is 50 million. So this is what we call as share split. Share split reduce the market price of the share, but it will increase the number of ordinary shares. What are the difference between share dividend and share split? Share dividend are sometimes mistakenly called as share split. All share dividend result in increase in the amount of share capital and decrease in retained earnings or other reserve. Share split do not. Yeah, when you have this share dividend, you increase the number of shares. Yeah, reduce in the retained earnings or retained profit. But for share split, no effect on retained profit, no effect on the number of no effect on the number of the amount, the value of ordinary shares. That is the difference. So we have share split. Share split. This is share dividend. Share dividend. Share split. Before this, your profit is maybe 10 million. Your ordinary shares before this is 1 million multiplied by $50. So it's going to be 50 million. Okay. After the conversion, it's going to be 50 million multiplied by $1. The same amount here, 50 million. Your profit is still the same, 10 million. Yeah, your retained profit. For share dividend, the profit originally is 10 million. Your ordinary shares is 50 million, example. And then after the share dividend, what happened is your profit, for example, you increase your ordinary shares to 55 million. Your profit now is 5 million. Mean reduce in the profit, increase in ordinary shares. Increase in ordinary shares. So that is the difference between the share split and share dividends. Okay, next we move to reserve. What is a reserve? Represent those items of equity other than capital contributed by the owner. Retained earnings or retained profit is one category of reserve, but many other reserves are created by transferring the amount out of retained earning account to set aside equity for particular purposes. So we have this when you study your EK 111. you only have one equity account. One equity account. Yeah, you have your capital plus net profit minus drawing. All right. So you have only one equity account. This is your AK 111 when you do your sole proprietorship. Later on last week, you studied about partnership. Partnership, yeah. The partnership. Okay, you have two methods. Method 1 and also method 2. Am I right? Method 1, you have this only capital account for A, B, and C. Method 2, you have two types of accounts. Am I right? For capital A, B, and C. Another one is for the profit A, B, and C. This is for partnership. For company, yeah, sometimes they call it capital and currents. Yeah, depends. Yeah, this is the fixed capital account. Yeah, format. And for company, you have your equity, your ordinary share capital. I click share capital. This can be ordinary share capital, can be preference share capital, and then you have retained profit reserve. Your reserve. You have a retained profit, and you have other reserve. So this is the different concept, yeah, different way of presenting your equity accounts in different type of business. So retained earning is one category of reserve, but many other reserves are created by transferring amount out of the retained earning to accounts to set aside equity for a particular purpose. When sometimes from these retained earnings, you can transfer that money to a special reserve. You can put general reserve accounts for other purpose. So we put aside the money for a special or unique purpose. Example of the reserve can be general reserve, option reserve, plant replacement reserve. You want to replace the plant, so you provide the money, put aside the money, or currency fluctuation reserve, and many other reserves. So this is just an example of reserve. So how you're going to create the reserve is very simple. Yeah. From the retained earning, from the profit, your profit is a credit accounts. This also credit accounts. So when you debit this account, mean you are taking money out from the retained profit and you're going to add to your reserve account. So debit, retained earnings, retained earnings, debit, and credit your reserve, creating your reserve accounts. Okay, so this is how you create the reserve accounts. Okay, when non-current assets are revalued outward, for example, your building, the building costs 25 million, and then later on you realize the value of the building now is 35 million. So you have this increase in the value of building. So your building, you're going to debit by 10 million. Okay, maybe the building has, let me see, this is the cost, the 25 million come from, let me see, this 25 million come from 30 million. The accumulated profit is 5 million. So that's why you get 25. This is the cost. This is the accumulated depreciation. Accumulated depreciation, 5 million. That's why the carrying amount is 25 million. So what you should do now is, you're going to debit this account, accumulated depreciation, you're going to debit, you're going to close that account by 5 million. I'm going to put my accumulated depreciation 5 million. Okay. Revaluation surplus, I'm going to add 10 million here. And the value of assets, I'm going to put another 5 million here. Yeah. Value of asset increased by 10 million. Or a simple word, Okay, there are many ways of doing this. This is the shortcut. Let me show you the long way of doing this. Yeah. Okay, step number 1, you have depreciation here. Depreciation. So I'm going to debit accumulated depreciation. Accumulated depreciation, debit by 5 million. And I'm going to put it asset. I'm going to reduce the value of asset, credit by 5 million. Now, if you have your asset building, the cost is 30 million. The cost is 30 million. Now you debit 5 million. The value of this asset is only 10 million. Am I right? 10 million. And number two, this is they combine it together. I'm showing you the long way. Number 2, you're going to debit your asset 10 million, and you're going to credit your asset revaluation surplus by 10 million. So if you look here, this one is debit, this is credit, so it's going to offset the account. Yeah. This is debit 10 million, this is credit 10 million. So if you combine this, it's going to be asset 5 million. Yeah, 5 millions. This is the way how to do it. Yeah. The surplus will be 10 million. This one asset will be 5 million, increase in 5 million. This one is reduce in accumulated depreciation by 5 million. So, but don't worry so much about this. The most important thing is you know that you will increase your revaluation surplus. This is your reserve by 10 million. Why 10 million? Because the asset value has increased from 25 million. The fair value now is 35 million. Okay. And that is the revaluation surplus. Okay. This is the 5 million. Let me just put here. This is the 5 million. This one. This credit 5 million. This is debit 10 million. So that's why we have debit 5 million. Okay. And this is the 10 million down here. Okay. But you're not going to be tested on this. This is just concept about reserve, how to create reserve accounts. For disposal of reserve account may be written off or reduced, for example, by paying a dividend, by share dividend from reserve, by transferring from one reserve account to the retained earnings, okay? And normally, for example, if you do that, so you're going to debit the reserve accounts and transfer the money to retained earnings. So your retained earning increase, your reserve will reduce. So that is how we dispose or reduce our reserve balance. Next will be income tax. What is income tax? A company has determined its profit for the period. A further expense for income tax must be deducted before arriving at the company's final profit after tax. You already total your revenue, total your expenses, revenue minus total expenses, you get the profit, but that is not final yet. You still have to determine what is the amount of tax expense need to be paid for that year. So that amount will be deducted from profit before tax, so you can reach profit after tax. So income tax payable by a company is based on the company taxable income as determined under the Income Tax Assessment Act and not on the company's accounting profit. It's based on the company's or based on the tax rule. Based on the tax rule. The tax is based on the tax rule. We're going to study this in detail when you do your AQ 200 later on. Your AQ 200. We have this accounting for income taxes. Okay. And then finally, you're going to prepare the financial statement. Okay. As with the sole trader and partnership, there are four main financial statements that are usually prepared. Number one is income statement, or in a company, normally we call it as statement of profit and loss and other comprehensive income, or statement of profit and loss and other comprehensive income, which shows all the relevant income and revenue and expense to measure the company's profit performance for the year. So this is statement number one, statement of profit and loss, or loss and other comprehensive income. Number two is statement of changes in equity, which shows the movement of company retained earnings, other reserve and share capital. When you study AK 101, you have statement of changes in equity. It's very simple. Opening capital plus net profit minus drawing. Opening capital plus net profit minus drawing. But for company's account, we have share capital, we have retained profit, we have reserve. We have many reserve. Can be general reserve, can be option reserve, so many reserves. So we need to track changes. What is change happen for your share capital, your retained profit, and reserve. You're going to present this in a table. Normally, a table is the easiest way to do it. So this is the opening. Then you have some reconciliation item here, plus minus, and this will be your closing for the share capital, for retained profit, for other reserve 1, reserve 2, reserve 3. So you're going to prepare this for your company income, but not in this semester, maybe next semester. Okay. Next is balance sheet, or known as statement of financial position. Statement of financial position. Okay. Which shows the company asset, liability, and equity on the last day of the period as a mean of assessing the entity financial position. So we're going to prepare this. And finally is statement of cash flow. This is a new document, new report, a statement of cash flow. You're going to use this to show the inflow, maybe the outflow of cash. We can categorize the cash to 3 activities. The first one is operating activity, the increase and decrease in cash from your operating activity, the normal business activity. Number 2 is from your investing activities, investing. And finally is your financing activity. So this will be a new document. I'm going to teach you how to prepare the statement of cash flow when you do AK 200 ME. The AK 200 ME. Yeah. Okay. And as a conclusion, there are different types of company exist in Australia. Yeah. Compared to the country in Malaysia, we have only company limited and unlimited company. But in Australia, they have many different types of company. And the establishment of company, it might bring benefit. At the same time, they also might have some drawbacks. The management structure commonly used for administering the company, as I mentioned before, we have the board of directors who will oversee, will monitor the managers, will set direction for the future strategic goal of the company. So we have this board of directors, and they have 3 main categories of equity in the company: share capital, return profit, and other reserve. And how we're going to issue share, this one Ms. Yusra will go very detailed with every one of you how to handle the issue of share, whether it's full or installment. Although installment is not so popular now, but you still need to learn how to record the adjustment. So your final exam, you'll be given the installment question. So you have to do that with Yusra. So the declaration and payment of cash on shares, cash dividend. We have number 1, cash dividend. Number 2, share dividends. Number 3, share split. So you have to know what are the difference between these three types of declarations. Yeah, declaration and reduction of different type of reserve. Okay, and also the income statement, income tax. So yeah, is calculated based on the profit before tax using the tax rule, and it's a must for company to pay tax to the tax authority, organizations, or bodies. A company's income statement, statement of changes in equity, and balance sheet for internal use. Yeah, previously only have income statement, balance sheet, and statement of changes in equity. Under company account, we have statement of profit and loss and other comprehensive income, similar to income statement. And then we have balance sheet, statement of financial position. And we have statement of changes in equity. Yes, we still have that statement of changes in equity. And finally, we have cash flow statement. So this is a new statement that you should learn, that you're going to learn when you do AKI 200. Okay, thank you so much. That is the theoretical part relating to the company and uh, how what's the process, the basic concept relating to accounting. Thank you so much.